Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and or financial topics. I obviously share my financial opinions as we go through it, but let's see what's going on in the social media world and what people are sharing. If you want to follow me, it's at @finding_finance, and if you want to join our community, finding-value.com. That is where I dive deeper into all of these topics. Um, Answering your questions with the question and answer sessions on the weekends, doing midweek updates for everyone in the community, and sharing my opinions freely on individual companies and setups in the markets and with those individual companies. So, Mark, I don't know how to pronounce his last name. Unjwitter, crude oil long term perspective. So, here is his perspective on crude oil log scale monthly closes. And then we've got the ratio on the bottom here for oil divided by gold. And you can see this ratio going back to 1965 and how this has worked its way on up. Here are the levels. You could see this was a slingshot oops before the big move up. And we've been consolidating underneath another resistance area is what he is showing. I'm going to show you what I see in the charts. So this is what he sees. We see a range from 1970s. We came and touched the bottom of the range, broke out to the top of the range, went sideways for a little bit, and then broke out. We're doing that same situational move here where you've got a three-hump consolidation, a three-hump consolidation. Here is underneath resistance. Here is underneath resistance. We're going to create like a cup and then maybe a little handle or some sort of pattern that we did there too, and then we break out and run. That's most likely the case. Now here's the thing that we don't know. We don't know if this is going to drop a little bit before doing that. If we're going to get a little bit of a move lower. It dropped here in 2001. That was your 9/11 and your slowdown. So it was a slowdown and 9/11 tacked at the end of that. Are we going to have another we'll call it 225. I don't know. Coming up here, I don't know. Difficult to say, but I can say this. When we were here, we had a very expensive oil to gold price in 2001 in relationship to where we are today. Today, we are like, this is super cheap. In fact, it's the second cheapest time in history going back to 1965. So you've got valuation at your back. Now, when I look at this, I'll bring this up and I'll show you what I see. When I look at the oil to gold ratio, I see that. That's what I see. I see a consolidation here. I see a breakout of the consolidation into a bull market that peaked here in 2008. That's your bull market. We went into another consolidation from 2008 in a three hump consolidation. Your first one is that guy there. Three hump consolidation. This is your end of trend consolidation in 2020. It's a capitulation move in a false breakdown. Now we've broken out of that consolidation. So we've broken out of the consolidation up. We're out of this, falling wedge. We go into another falling wedge coming down here, and we're tracking sideways in the corner here. Generally, right before a move, you track sideways. It's called the dead period. So we've pulled on back. We could be bottoming here where we go and move on up. Now, here's the thing. This could also do a false breakdown like this. People will start to short crude oil. Then it slingshots back in the opposite direction. And that is this setup here, where it gets everybody short and then it squeezes everybody upward. We've been seeing this slingshot move, and I don't think it'll be that big, but we've been seeing that slingshot move at these ends here where we could do that. It scares people. It scares people because it goes down and you don't want to see that in your portfolio account. You don't want to see the movements in oil equities and some of this stuff, but it's got a falling wedge. It's broken out of the other falling wedge here. And to me, this looks like a bullish formation. The other way I view it is this is US oil going all the way back. And if you've been part of all this, you guys know what I'm talking about here. This is the long-term channel that I see going back to 1862. 1862. You get a consolidation, breakout, consolidation, breakout, consolidation, breakout. Now we have broken out and we are consolidating on top of that consolidation. That is a bullish formation. These generally run with gold. Gold ran up, gold ran up, gold's going to run up. So the big question that everybody's trying to figure out is they reject the long-term view and then they zoom in and this is what they see. They see that this has fallen back and we could potentially have a recession, and that very well could be the case. But you lose the perspective of the long-term advantage. Long-term, this looks good, like a buying opportunity there. Could we go into the 50s? We could. We could. I don't know that. You know, these false, if you look, you get these false breakdowns. So when this was squeezing up, it was coming down. We came to this point here, there's your false breakdown. And then it slingshots up. Then we came to this, and you draw your deal. False breakdown there. And then here we had a false break just below this to get everybody scared. And you're probably going to get a false breakdown at any second here. Me and everyone on part of the community, we're going to take advantage of this. We're going to buy it. We're going to roll this thing because Daddy, me, needs to retire. Well, not retire from the website, but I'll just say hypothetically make a bunch of money. Put it that way. And if we go up here, guys, the companies that we're in, they're going to go up massively. The problem is we're going to experience a lot of volatility before that. So letting you guys know. Copper decline in large-scale copper discoveries. Again, I'm putting this information. We're seeing some bearish activity in the markets, related to commodities. We're not finding jack crap here, guys. There's nothing. Nothing. We are finding zero large copper discoveries. Where is this copper going to come from? No one knows. So here's another thing. If we can't get the copper that we want and desire as the world, if copper is literally the transition metal that will keep us from making all these electric vehicles and transmission power lines and renewables or whatever else, shouldn't we bet that this large copper discoveries has gone to zero? Shouldn't we be betting on what the alternative is? What's the alternative? Oil, natural gas, using more ICE, internal combustion engine cars because they're less mineral intensive, hybrids, platinum, palladium, rhodium, like all these different things come to mind because I don't think the copper is going to be there. Here's SILJ versus URA ratio. Some interesting charts showing up on the miners versus uranium. Here we have a bull plot where the silver junior miners recovered from a fake breakdown of the sideways range and popped the pattern and now back testing. Needs to take it weekly 150 moving average to show true grit. Yeah, your breakdown, it almost always has been doing this now. You get these breakdowns and then they slingshot to the upside and then you come back and do a retest from a top. So this is showing that SILJ would be your bet versus URA. This also might mean that we're in a certain market condition. It did this back in 2016. 2016 all the way, and it created the falling, pattern here that broke out again. The ultimate double top in this ratio, which was 2021. Uranium outperformed, and now it looks like SILJ could outperform. JSG. So I like this guy's analysis here. He says WTI significantly undervalued based on my latest comparative inventory analysis as of 12/4/2022, 2024 by $20 a barrel. At some point, this will matter. My calculated WTI fair value price based on inventory levels is $87 USD. So that's based off a historical dot plot and then running the calculation of fair value and then your, I don't know if this is one standard deviation or so around it, could be a couple. And look where we're at. We're outside of that standard deviation. And it's come out here a couple times. You can see a couple of dots out there. But I would say this is an opportunity. Now, here's the thing. I don't know how this is going to normalize. Does it normalize upward where the fair value is at $87 up here? So the fair value needs to be up here. That's how you get to the fair value. You go straight up. Or does it normalize with inventories going up and this slowly working its way back this way to the right? More so. That's where people are speculating. But I will say this. When you want to buy oil, you want to buy when it's undervalued, when it's down here. And we know it's cheap in relationship to gold. Went over that earlier. But that's where we're at. That is information that's not an opinion. This is looking at data and showing you what the data is telling you from this perspective. It doesn't say anything about opinions and sentiment. And if a recession does come, that is unknown. BlackRock boom only, no more bust. So world economy has exited the boom and bust cycle, BlackRock says. Well, isn't that kind of time to get worried? I also saw that. So yeah, here's the other one. He said, I thought I heard that before somewhere at some time. Boom and bust is at an end, says Brown. And that was the year 2000, March of 2000. Gordon Brown claimed he had eradicated the boom bust by forecasting. This is when they were selling all their gold, too. Man, did they get that wrong. The boom and bust is at an end. World economy has exited the boom and bust cycle, BlackRock says. 2024 is analogous to the year 2000 when this came out. That's probably where I think we're located, is right around 2000. We're probably going to do it could be a bust cycle here any second. And then if we bust, depending on what the bust looks like, commodities are going to boom right shortly thereafter. You'll get a weaker dollar, yields will drop, and then you'll get a huge money rotation. Warren Pies, he says single stock long ETFs have seen about 10 times the volume of single stock short ETFs. Noteworthy, levered long ETF bets soaring signs of froth. Sentiment is good, is really what it's saying. Sentiment is too positive. That's what frothy means. Big companies have small moves, small companies have big moves. Another thing also is small companies have big volatility. And choosing companies, you're going to have to match your emotional stability with the size of the companies. So big companies have small companies have big moves, and they're also the volatility goes with them. India's oil demand rose by 9.3% year over year to 20.5 million metric tons in November. I thought we had demand problems. Well, that's all over in China, right? But India is crushing. They are ripping oil demand higher. Warren Buffett, do not save what is left after spending, but spend what is left after saving. Do you guys do that? Do you guys budget out your savings or do you budget out your spending? What I do, and I'm crazy, I don't really budget at all. I just ask myself, do I really need this? And I don't really spend much on crap, just crap is what I'll call it. And I really invest as much as I can. And maybe I'm doing it wrong. Maybe I'm saving too much money. It very well could be the case. So I'm going to try to work on it. I think I've got to levels that I feel comfortable with, and then I will try to spend a little bit more money than probably what I have historically. Eric Nettle says HRH. There's a separation now between fundamentals, and I believe fundamentals are telling us a completely different picture or drawing us a completely different picture than what you see today. And the sentiment that has been drawn by all sorts of different parties with all different incentives and motives. We had the double task of attending to fundamentals, yet putting together something that mitigates this negative sentiment. And this is the decision to delay oil output increases was a reality check that OPEC Plus had to attend to. Saudi energy minister tells CNBC. And remember, there was articles coming out. Just here, I want to make sure everybody understands something. There was articles being pushed out, multiple articles, multiple, not just one. One of the articles stated that Saudi Arabia was going to get into an oil war with shale and bring prices way down. That was one of the news articles. And there was another article that came out. There's like two or three other ones, all right at the election timeframe. They were all released right before the election. So here's my question to all of you guys. If they are doing that, if it becomes so obvious that they're pushing these things out there, well, to what extent do you think that they are behind the scenes manipulating this stuff? If they're willing to throw all these articles out there and do that, what extent are they doing? I go and I look at gold, right? And this is why it's so important to take a long-term mindset. So here's gold. This is the long-term gold price. I just do this. Throw that in there, falling, a wedge type formation breakout. Boom, 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 all the way up. Then you can see we had another breakout here. And that, for the most part, is the shoulder head shoulder. Some people call it. Some people call it a cup and handle. Like it's like a cup and a handle. Whatever it is, it doesn't really matter. It's a consolidation. We have another one here. Something that's like almost like another cup and handle. So like your cup, your handle, something like that. Could be that shoulder head shoulder. That fractal is the same fractal. This fractal there is the same fractal here. It's the same setup. And we've broken to the upside. Now, these guys are releasing all sorts of stuff of this, right? You could also state that that fractal maybe could be coming soon, where we do break out again, which hopefully that's what comes. But what if they are manipulating this to a large extent? And I know a lot of people think that is, but maybe all of these big moves are manipulation to some degree. This was October 24. This was November 6th. This was when Trump went into office. And then we came on down and we've been consolidating here on the right-hand side. And this could break to the upside. We'll see. But, I don't view it as this little, section there. I view it like this. I view it like that. And it's like, well, I could accumulate gold from 2002 onward. If you've been accumulating gold, you've done absolutely fantastic. And don't worry about the wiggles. Don't worry about the wiggles here. And yeah, it was a couple years. But what I hear with a lot of people, oh, well, this is a good time to go buy something else. So, yeah, that's true. But if you held on, you're killing it. You're killing it in gold. So that's my view there. Absolutely killing it in gold there. So we've got November payrolls. So unemployment rate ticks up 4.2% versus the 4.4% September estimate. Residential construction payrolls still at cycle highs, which is what he shows below. But there is a chill sweeping through builder activity. Completed inventory is stacking up. Odds of December cut move higher. So he's watching the US employees, specifically construction payrolls, because that's where your recession comes from. If a recession is coming, we would see the residential construction payrolls start to decline. If that declines and you start to see the home builders decline, the home builder stocks, that's most likely a recession is probably coming. Then you look at the 2-year yield. If the 2-year yield starts to drop like a rock, yeah, it is not so good. Brent wave, the crude market is continuing to see some improvement for Aframaxes and Suezmaxes, but flat for the VLCCs. The OPEC Plus decision to delay the start of cut reversals is unlikely to spur much action. The potential triggers for a rally are all related to China. Will refiners boost imports? If so, when? And will they seek to diversify supplies away from Iran? In our book, the answer is yes on both, but the timing window is a wide one, says Arctic. That timing window is where everyone is so obsessed. Use strategies to buy undervalued assets and just wait. Like the window there, no one's going to know the exact time, but you know when something's cheap. Here is another tanker one. So let's talk more about tankers. The main reason tanker rates and equities have sold off from their June highs, huge global inventory drawdowns. The 150 million barrel drawdown since early June represents 30 VLCC equivalents that went unemployed versus a flat inventory counterfactual threat. It says with inventories at bottom of 5-year averages, it seems unlikely that inventories decline meaningfully from here. Just returning to flat inventories add back the 30 VLCCs of demand, adding the expected 1 million barrels per day supply demand growth in 2025 requires another 30 VLCCs. Therefore, my base case for 2025 sees 60 VLCC equivalents employed versus levels seen since June. This is a fleet of 900 VLCCs. So it's a plus 7% utilization relative to recent months. A bull case exists where capacity in excess of 1 million barrels per day demand growth, and inventories actually build at the same pace they did before being depleted in recent months, adding another 30 VLCC demand and increasing utilization by plus 10% relative to recent months. This is not to mention a slew of other major bullish catalysts for rates in 2025, including renewed Trump sanctions on Iran. Nearly 10% of the operating VLCC fleet are greater than 20-year ships carrying sanctioned oil that would otherwise be scrapped with enforcement. And he says, I don't own enough tankers. The Iranian fleet of 40 plus tankers will go back to being floating storage. And all of this oil will need to be shipped by the legit fleet from Saudi instead. Huge tailwinds to rates for. So even with status quo of an ever-growing dark fleet and no scrapping, the effective VLCC fleet will still shrink over the due to very few new builds and rapidly decreasing utilization rates as 50 more VLCCs turn 20 years old. And this is the chart of Matt Fredrickson on the VLCC market. Some of those by age count. So 7, the conclusion here. The low tanker rates since June are anything but normal and are definitely not the new normal. They are the result of the perfect storm of inventory drawdowns, unenforced sanctions, and unusually high refinery maintenance. A simple return to normal equals much higher rates. After thorough review, the tanker thesis is still 100% intact with huge convexity to the upside if we see more sanction enforcement like those announced yesterday, or heaven forbid, an oil spill from a dark fleet rust bucket that would see these ships banned by China. The recent tanker sell-off is a gift. Tanker equities trade at steep discounts to NAVs, which I believe more accurately represent net present value of future cash flow. It says my favorite tanker operator and largest holding is NMM, trades at the largest discount to NAV of any shipping company that is actively huge upside convexity as they are retiring shares at 35 cents on the dollar. And that's what we've got for that. I'm going to end it there. If you guys want to know what I like in the tanker area, it's all on the website. True. And if you throw in the mix of to flip into contango, inventories will build even faster, and then everyone will be scrambling for tonnage. 2015 all over again. Lots of good things coming on up for that. Coming on back. The longer we can extend your time horizon, the less competitive the game becomes, because most of the world is engaged over very short time frames. William Brown. He is completely right. Completely right. But that's where we're going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. That's what we've got. You can use a different discount coupon code if you want to try it. It's called discount. It's not going to give you as large of a discount as what we had in the Black Friday. But that's what we've got for today. We'll catch you later. This is Finding Value.